Welcome to the Deep Dive, your shortcut to being genuinely well-informed. We try to pack in surprising facts and, well, just enough humor to keep you hooked. Today, we're diving headfirst into the fascinating, really fast-paced world of algorithmic trading. It's this whole story of how artificial intelligence is rapidly reshaping financial markets, pushing us into what some people are calling cyborg finance, where human and machine roles start to blur. Our mission for this deep dive, it's to unpack the complex forces behind all those headlines. We want to give you a crystal clear understanding of its history, its sometimes mind-bending strategies, and maybe surprisingly, the pretty profound ethical questions that come up when algorithms increasingly dominate our markets.
Exactly. And to do that, we've basically sifted through a mountain of sources for you. Everything from, cutting-edge academic papers and deep industry reports to insights from real-world applications and the challenges faced by people actually on the front lines. We're really here to distill what's most important, what's most relevant, so you can walk away truly well-informed on this incredibly fast-evolving subject, ready to understand the why behind the headlines.
Okay, let's unpack this then. For anyone who's maybe dipped their toes into finance, you probably heard the term, but let's just quickly align on what exactly algorithmic trading is, at its core. Essentially, it's a method of executing orders using automated, pre-programmed trading instructions. These instructions account for variables like time, price, volume, that sort of thing.
Right, and the core advantage is just undeniable, isn't it? It leverages the sheer relentless speed and computational power of computers. It's far beyond anything a human trader could ever, hope to achieve.
And it's not just for the big players anymore either. It's gaining serious traction with both retail and institutional traders. I saw this striking statistic from a 2019 study. Around 92%. 92% of trading in the Forex market was done by algorithms, not humans. Just think about the scale of that shift.
It's huge.
It's so dramatic that the NASDAQ Q CEO, Robert Greifeld, once declared, and this is a quote, "It is over. The trading that existed down the centuries has died. We have an electronic market today. It is the present. It is the future." It really feels like we've crossed some kind of Rubicon.
It does. And what's truly fascinating here is that while it feels so revolutionary today, the seeds of this computerization, they were actually planted much, much earlier. We're talking the early 1970s. The New York Stock Exchange introduced systems like designated order turnaround, or DOT. Which was then upgraded to super DOT in 1984. This really set the stage for what they then called program trading in the 1980s.
Program trading.
Right. Defined by the NYSE as orders, I think it was 15 or more stocks valued over $1 million US, it became widely used, especially in index arbitrage. And controversially, many linked it to exacerbating, maybe even starting, the 1987 stock market crash.
Black Monday.
Yeah.
Yeah, I remember hearing about that connection.
So its full impact is still, debated. But it was definitely an early sign of the power these automated systems could have. But the real key catalysts, they really arrived in the 1990s and 2000s. You had the emergence of electronic communication networks, ECNs, allowing trading outside the traditional exchanges.
Right, opening things up.
And then a truly pivotal moment was decimalization in 2001. That's when the minimum tick size changed from like a 1/16 of a dollar down to just 1 cent per share.
Just a penny.
Exactly. And this dramatically increased market liquidity. It really encouraged algorithmic trading because it allowed for much smaller differences between the bid and offer prices, essentially opening up all these new opportunities for tiny, rapid gains.
And I guess the aha moment for many probably came around then, 2001, when those IBM researchers published that paper showing their algorithms, MGD and ZIP, they consistently outperformed human traders in these experimental auctions. They even wrote that the potential financial impact could be measured in billions of dollars annually. That's a pretty powerful validation right there.
And it absolutely was a huge signal. And when you put all of that together, the overall impact is just massive. Increased transaction volumes, reduced costs, generally improved portfolio performance, and arguably enhanced transparency in financial markets. Just look at the Forex markets again. Daily turnover hit US $6.6 trillion in April 2019. That's a significant jump from US $5.1 trillion just back in 2016. It just goes to show how much these systems have, supercharged market activity.
That history really shows how rapidly the groundwork was laid. But okay, once you have the speed and the connectivity, what exactly are these machines doing with it? How do they decide what to buy or sell? I know a common approach is taking a single large parent order and breaking it down into lots of smaller child orders for execution. But what about the strategies themselves?
Precisely. That breaking down of orders is crucial, mainly for managing market impact. But the real intelligence, yeah, that's in the strategic approaches. Let's dive into some of the core ones. First up, you've got arbitrage. This is the classic concept, right? Seeking risk-free profit by exploiting tiny price differences between two or more markets, ideally simultaneously.
Like finding a $20 bill on two different streets at the same time.
Sort of. Think if S&P futures and the actual S&P 500 stocks show a fleeting price disparity, an algorithm can instantly buy in one market and sell in the other to capture that difference, way before a human could even blink. The condition for true arbitrage is, no negative cash flow and positive cash flow in at least one state, but you always have this thing called execution risk, or leg in and leg out risk. Meaning, if those simultaneous transactions aren't perfectly simultaneous, one leg of the trade might happen, but the other doesn't. Or it happens at a worse price, the tiny profit disappears. Or you might even lose money. It's like trying to hit two moving targets with one shot. You need perfect timing.
Gotcha. So it's about being incredibly fast to exploit those momentary mispricings.
Exactly. Then you have mean reversion. This is based on the idea, or the observation really, that a stock's price tends to have an average over time. And deviations from that average will eventually revert back to it.
The market equivalent of a rubber band snapping back.
That's a great way to put it. So an algorithm might buy when the current price is lower than its historical average, anticipating it'll rise, and sell when it's above, expecting it to fall back.
Right.
It's betting on things returning to, normal.
Makes sense.
Now, probably the most common category of algorithmic trading is transaction cost reduction. The goal here is pretty simple. If you have a massive order, say you need to buy 1 million shares of something, you don't want to just dump that order onto the market all at once.
Right. You'd move the price against yourself.
Exactly. You'd push the price up before you finish buying. So these algorithms break down those large orders into small ones and place them in the market strategically over time to reduce the overall cost impact. Think of algorithms like volume-weighted average price, or VWAP, and time-weighted average price, or TWAP. They schedule trades based on historical volume patterns or simply spread them out over a set time period.
It's trying to blend in with the normal market flow.
Precisely. And there are even these so-called sniffing algorithms that try to detect large hidden orders, often called iceberg orders.
Icebergs. Because you only see the tip.
You got it. An iceberg order only shows a small fraction of its total size publicly. It's designed to hide the trader's true, large intent. Sniffing algorithms try to figure out if a big order is lurking beneath the surface.
So they're like digital detectives trying to figure out what the big players are really up to.
You got it. And that leads us nicely into high-frequency trading, or HFT. This is kind of the extreme end, characterized by extremely high turnover and very high order-to-trade ratios, making decisions based on electronic information before humans can even process it. The speed is just mind-boggling. Look at Virtue Financial. They famously reported being profitable on an astounding 1,277 out of 278 trading days over a 5-year period.
Wow. 12,277 out of 12,278. That's wild. The real insight here isn't just that they're fast, though, is it? It's what it means for the very definition of a fair market. I mean, if success is measured in microseconds and it's really only accessible to a select few with the best tech, is the ideal of a truly open market still within reach? Or are we fundamentally reshaping who gets to win?
That is a critical question, and one we'll definitely come back to. HFT firms often engage in market making, continuously quoting buy and sell prices to capture the tiny bid-ask spread. Or they do statistical arbitrage, exploiting really complex statistical relationships across many different securities. And event arbitrage, trying to profit from specific predictable events like mergers or earnings announcements.
Oh, okay.
And then you also have dark pools. These are basically private trading systems, off-exchange venues that offer undisplayed liquidity, mainly for trading large blocks of securities.
So trading happens away from the public eye.
Exactly. Trading takes place anonymously, and orders are often iceberged, like we mentioned, to hide their true size, which of course leads to another cat-and-mouse game. There are folks known as gamers or sharks who try to sniff out these large hidden orders in the dark pools by pinging them with small market orders, essentially testing the waters to see if they hit a big hidden order.
Fascinating. It's clear that these traditional algorithms are incredibly powerful, but here's where AI really takes it to a whole new level, right? AI's leap in data processing is just remarkable. I read it can process over 100 terabytes of data for investment insights, analyzing literally hundreds of variables compared to maybe the tens analyzed by traditional models.
The scale is completely different.
Exactly. And this brings, well, unmatched speed, accuracy, crucially, emotion-free decision-making, and continuous risk management to the table. We're not talking about a small tweak here either. AI-powered algorithms now handle an astonishing 80% of trades in U.S. markets. 80%.
Think about that, 4 out of 5 trades.
And the potential financial impact. McKinsey estimates AI could add something like $3.8 trillion in annual profits to the global financial services industry by 2025.
Yeah.
It's just staggering.
It really is transformative. And you asked how AI enhances these things. Well, machine learning, for example, is now pretty fundamental to financial analysis. It sifts through these vast data sets, looking for patterns, building predictive models, anticipating movements in stock prices or consumer trends or whatever it might be. It also performs sentiment analysis using natural language processing, NLP, analyzing news articles, social media feeds, trying to gauge the real-time market mood.
That's fascinating. So it's not just crunching the numbers, it's trying to understand the narrative or the feeling around the market.
Exactly. It's like having a superpowered market psychologist working 24/7. Then there's AI-powered portfolio optimization. These systems are revolutionizing investment by creating optimal portfolios. They adjust asset allocations by rapidly analyzing both structured data, like price history, and unstructured data, like news, social media trends, economic indicators, all to boost profitability and systematically manage risk. It's about getting the best bang for your buck, continuously adapting.
Okay, so it's constantly fine-tuning?
Constantly. And perhaps one of the most cutting-edge examples, something that really highlights that cyborg finance concept we mentioned, is adaptive reinforcement learning, or ARL. There was a really interesting University of Cambridge working paper detailing this. It's a layered approach.
Layered how?
Okay, so at its foundation, you have a machine learning algorithm. They use something called recurrent reinforcement learning. Then, on top of that, there's a crucial risk and performance management layer. This includes safeguards like a trailing stop loss to prevent, emotional decisions letting losses run. It also has a cool down period after unexpected losses to avoid revenge trading.
Smart.
And even an auto shutdown function based on maximum drawdown, basically to lock in profits or cap losses. Then the top layer is a dynamic optimization layer. This is really cool. This layer automatically tunes critical parameters within the algorithm itself, things like transaction cost assumptions, how deep the stop loss should be, the trading threshold, all to maximize whatever the user defines as their utility.
Utility, meaning?
Meaning what they value most. It could be maximizing raw return, minimizing risk, some balance. It's based on their personal risk aversion. The system adapts to them.
Wow, so the system literally learns and adapts its own settings based on my personal risk appetite. That's incredible. It takes away so much of the manual guesswork and, frankly, the emotion that often trips up human traders. It's almost like having a truly personalized, unbiased co-pilot.
It absolutely is. And the results they reported from their Eurodollar FX trading application were pretty compelling. The ARL system earned 5,104 pips over 2 years.
Pips, right. Those tiny currency movements.
Exactly. That equates to roughly 26% per annum return. Now, compare that to a simple buy and hold strategy for the same currency pair over the same period. That resulted in a 1636 pips loss, roughly an 8% per annum loss. And crucially, they noted the ARL system successfully avoided any serious drawdowns, meaning large losses.
That's key, avoiding the big hits.
Absolutely. So what this means is that ARL eliminates the need for constant manual model calibration. It dynamically adapts to changing market conditions and the user's risk preferences. And critically, it significantly reduces what's called data snooping risk. That's where models get unintentionally over-optimized on historical data. They look brilliant on paper,
But fail in the real world when things change.
exactly. They become too good at predicting the past. ARL's adaptability makes it much more robust. It's a huge leap towards more intelligent, truly adaptive AI in trading.
So, okay, we've seen the incredible benefits. The speed, the efficiency, the emotionless decision-making, the adaptability with things like ARL. But with this level of automation and speed, there are critical downsides, right? Concerns that really bring home the implications of cyborg finance. One is often called the black boxness of these systems. I've heard traders express concern that they kind of lose their intuitive sense of how markets actually work when algorithms make decisions that aren't always, well, intuitive or clear.
Yeah, the reasoning isn't always transparent.
It's like trusting a GPS without knowing how to read a map anymore, maybe. Then there's the very real danger of system failures, glitches. We saw this infamously with the Knight Capital Group incident in 2012. A software issue caused a staggering $440 million loss for the firm in a single day.
45 minutes, wasn't it? Devastating.
A $440 million loss. That's the kind of number that could make any CEO reach for the nearest kill switch, right? It really underscores that even in a world dominated by algorithms, human errors in programming or just basic oversight can have truly catastrophic, very human consequences.
It's a stark reminder that technology isn't infallible, absolutely. And what about outright market manipulation? Even though they're officially prohibited, tactics like spoofing, placing orders you intend to cancel just to mislead others about supply or demand.
Creating a false impression.
Exactly. And, quote, flooding the market with huge numbers of orders just to slow down competitors' data feeds and gain a tiny speed advantage. These are real concerns. These strategies leverage speed to gain an unfair edge. And this all contributes to that emerging concept of cyborg finance, where machines and humans are increasingly sharing these dominant roles. It leads to increased speed, connectivity, reach, complexity. But maybe it reduces some of finance's humanity as trading becomes less about interaction and more about code.
This raises a really important question then.
Yeah.
How do these systems actually behave under stress?
Yeah.
Because markets aren't always calm and orderly, right?
Not at all. And that's precisely what we saw glimpses of in the 2010 flash crash. An algorithmic trade, specifically a large sell order, was identified as a key trigger for that massive sell-off. The Dow Jones Industrial Average just plunged hundreds of points in minutes before recovering. The International Organization of Securities Commissions, IOSCO, they looked into it and concluded that, yes, algorithms and HFT definitely contributed to that volatility.
Made it worse, basically.
Amplified it, certainly. And this brings us to something known as the execution algorithm trilemma. It's a core trade-off that anyone using these tools faces.
The trilemma, okay. What's the trade-off?
Basically, no single execution algorithm can simultaneously optimize for three desirable things: minimizing market impact, not moving the price against yourself, minimizing market risk, getting the trade done quickly before the price moves away, and maximizing execution certainty, making sure the trade actually happens. It's this constant balancing act. You're always having to prioritize. Do you want to be stealthy or fast or absolutely sure you get filled? You usually can't have all three perfectly optimized at once.
So it's always a compromise. Interesting.
Always. And another significant challenge, especially when you think about ethics, is unequal access. This is huge. High-frequency trading, as we said, relies on ultra-fast networks, co-located servers, literally putting your servers in the same data center as the exchange's matching engine.
To cut down on milliseconds of delay.
Exactly. And specialized, expensive live data feeds. These resources are primarily available only to large institutions, hedge funds, investment banks. This creates a massive gap. Retail traders, even smaller institutions, simply cannot match that speed or precision. We're talking about ultra-low latency, often under 1 millisecond for trade processing. It's a literal arms race for speed, and most individual traders aren't even equipped to compete on that level.
A two-tiered market, essentially.
Some argue it's becoming that way, and these systems also have profound market structure impacts. The paradox is that while algorithms often aim to simplify communication, between buyer and seller, the overall market can actually become more complex and uncertain because of them. We see phenomena like liquidity mirage, where electronic order books look deep across fragmented trading venues, but that liquidity can vanish instantly under stress. And latent liquidity, referring to all that hidden trading interest, like those iceberg orders, it makes it harder to know the true state of supply and demand sometimes.
So for regulators, this must be a constant headache. How are they even trying to keep up with all this?
They are trying. Regarding regulatory efforts and controls, you see things like, in the European Union, they've mandated rigorous testing of algorithms and reporting of any disruptions, trying to minimize manipulation and instability. It's also become crucial to have embedded controls within the trading systems, things like throttles that limit order rates and kill switches.
The emergency brake.
Right. Mechanisms to automatically pause or halt execution if things go haywire, like with Knight Capital. However, there's a potential concern there too. What if many firms' kill switches are triggered simultaneously during a market panic?
Oh, right. Everyone hitting the brakes at once.
Could paradoxically lead to a sudden, sharp withdrawal of liquidity across the market, potentially causing even more dramatic price movements. So it's a really tricky balance to strike with those controls.
Yeah, unintended consequences.
Oh, exactly. And finally, it's worth looking at algorithmic performance during actual crises. Take March 2020, right at the start of the COVID-19 pandemic market volatility. Things were wild. Bid-ask spreads blew out, volatility quadrupled. But interestingly, reports suggest that FX execution algorithms, EAs, actually doubled in volume during that period, and they largely outperformed traditional risk transfer methods, basically calling up a bank for a quote. Especially the passive and hybrid algorithms seemed resilient.
So they held up reasonably well under extreme stress.
In many cases, yes. Which is maybe surprising. However, it's also worth noting that some of the more dynamic adaptive algorithms still needed manual retuning by humans during that period. So it tells us they're good, they're resilient to a point, but perhaps not yet a panacea for absolutely all market conditions. Human oversight is still critical.
Okay, so we've covered the incredible ascent, the power, but also the serious challenges and risks of algorithmic trading and how AI is amplifying both sides of that coin. But let's shift gears a bit, look forward. Are there efforts to bridge that ethical gap, that unequal access problem, and maybe democratize this algo advantage? I came across a company called Algo Forest Group, for instance. Apparently, they've been awarded the 2025 Global Best AI Algo FinTech Enterprise Award for the 6th consecutive year. And their whole mission seems to be about leveling the playing field, making smart, data-driven decision-making accessible to everyone, not just the big institutions.
Yes, that's a really interesting development and part of a broader trend, I think. What's particularly exciting there is their innovation. The AI Signals page. From what I understand, this platform integrates AI-powered insights, but also collaborative learning elements and real-time strategy sharing. It's described as the first platform globally to integrate AI insights directly with data from, get this, over 4,000 global brokers and banks.
Like 4,000 sources, that's huge integration.
It's a significant step towards bringing transparency and accessibility to what's traditionally been a pretty opaque and exclusive market, especially the algorithmic side.
And looking at the features, it seems packed with things for the everyday investor. Like, you can use natural language queries, just ask it in plain English, which strategies performed best last week? It literally understands your questions.
That lowers the barrier to entry significantly.
Totally. It offers macro overlay tools, so you can see how your trades fit within global events and news, anomaly detection for early warnings, even simulated trading competitions, which sounds fun, where users can compete and compare strategies without risking real money. Plus, you get these AI-generated personalized strategy analysis and optimization recommendation reports. It seems geared towards empowering you, the individual trader, to analyze your own risk management and strategy performance, giving access to tools that were previously just for the pros.
And if we connect this back to the bigger picture, the core ethos behind this kind of democratization trend is really crucial, I think. These innovations, they're generally not trying to replace the trader. The messaging is very much about supporting and amplifying their ability to make better decisions with better data and better tools.
Augmenting human intelligence, not replacing it.
Exactly. The focus seems to be on promoting responsible, educated trading and fostering a more collaborative, inclusive community for traders of all backgrounds and experience levels. What's more, I believe the AI Signals page is slated to remain freely accessible, which really underscores a genuine commitment to financial inclusion, particularly for maybe underserved markets or individuals who wouldn't normally have access to this level of analysis. It's a powerful move towards making cyborg finance potentially more accessible, maybe more equitable for all of us.
So we've really journeyed from those early days of electronic trading, the DOT system, all the way to these incredibly sophisticated AI-driven algorithms of today. It's truly a story of profound transformation in financial markets. We've seen the incredible efficiency gains, but also those persistent challenges, especially around fairness, complexity, and access in this new era of cyborg finance.
It leaves us with a pretty important question, doesn't it? As AI continues to become this indispensable partner in investment decisions, the future of finance seems to hinge not just on more technological advancement, but really on how effectively we humans and these machines can collaborate. It's about balancing that relentless pursuit of efficiency with what we consider essential values. Fairness, transparency, accessibility for everyone. What new frontiers will this human-AI partnership unlock? And maybe more importantly, what new responsibilities will it demand from us, from society, as it continues to evolve? What do you think the next big aha moment will be in this constantly shifting landscape?